Welcome back to the deep dive. Today, we're taking a very specific approach. We're diving into the Q3 2025 earnings call. But, and this is key, we're filtering out, the big picture strategy talk, the marketing spin. We want just one voice, the Chief Financial Officer's financial overview, pure numbers.
Exactly. The mission here is to pull out the story the numbers themselves are telling. What are the critical metrics, the KPIs, the forward guidance that really matters for understanding how the business is actually operating right now? We're aiming for a clear, sort of structured look at the data. And we're keeping one big question in mind throughout.
Which is?
Is this strong performance we're seeing really coming from, like organic strength and good cost control? Or is it mostly driven by all the recent big acquisition activity? That's the tension we need to explore.
Okay, yeah, good frame. Let's jump right in then. The CFO kicked things off with some pretty impressive headline numbers. The first one that jumps out is the streak, the 58th consecutive quarter of double-digit revenue growth.
58. That's kind of incredible, isn't it? Over a decade of consistent double-digit growth through all sorts of market conditions. And for Q3 specifically, that growth hit 20% year over year.
20% on the top line. And what's interesting, as you hinted, is how they got there. It wasn't just about spending more.
Right. The CFO highlighted significant margin improvement, specifically in their core commercial information and marketplaces brands. Those margins hit 47% this quarter. That's up quite a bit from 43% in the same quarter last year.
So faster growth and better margins. That's what you want to see, right? Suggests real operating leverage.
Absolutely. It points towards efficiency gains, not just buying growth. And that efficiency seems to be fueling future potential, too, especially looking at net new bookings.
Ah, yes, the bookings, they were huge.
Huge is right. $84 million in net new bookings. That's almost double year over year, a 92% increase. And the CFO directly linked that surge to the expanding sales force, which is now over 2,000 people.
A 2,000-person sales team driving that kind of booking growth. That definitely signals momentum carrying into Q4 and beyond.
Yeah, exactly. Those bookings turn into revenue down the line. Okay, so let's get into the actual dollar figures for Q3.
Total revenue landed at $834 million. But here's where we start dissecting that organic versus acquisition question.
Yeah, this is important. The CFO broke it down. $808 million, that was purely organic revenue. The other $25 million came from the domain acquisition, which we'll get into more detail on later.
So the core business, even without domain, beat their own guidance.
It did. The organic revenue alone topped the high end of their previous forecast. That's a strong validation point for the underlying business performance.
And the profitability story. Adjusted EBITDA.
Also very strong. Came in at $115 million. That translates to a 14% margin for the quarter.
$115 million. Wasn't the guidance range much lower, like $75 to $85 million?
Exactly. They blew past the high end of their own guidance by $30 million. That's a massive beat on profitability. Right. Almost 50% higher than the midpoint they expected.
Okay, so why such a big beat? What did the CFO say?
Two key things. Continued expense discipline, so tight cost management, and simply better than expected revenue performance. It wasn't just one or the other. It was that combination.
That combo is crucial. Like you said, it reinforces that efficiency angle. They managed costs well while integrating these big acquisitions.
Right. If it was just acquisition revenue driving the beat, you might expect margins to get squeezed by integration costs.
Right.
The fact margins held up or even improved while folding in Matterport and Domain, that says a lot about their operational control.
Okay, let's pivot slightly. How did the individual core platforms perform? Starting with the foundation, the CoStar product, information services.
CoStar itself showed solid 8% revenue growth in Q3. Steady, not spectacular, but it's the base. What's more telling, perhaps, is the booking momentum. Net new bookings for CoStar are apparently at their highest level since way back in 2022.
Highest since 2022. So that suggests a potential reacceleration or renewed traction there.
That seems to be the signal, yeah. It suggests maybe some of their recent product investments are starting to pay off.
And that booking strength explains why they nudged up the guidance for CoStar, right?
Correct. They're now calling for 8% to 9% growth in Q4 for CoStar, which pulls the full-year growth expectation for the segment up slightly to 7% versus the original 6% to 7% range. It's a small tweak, but positive.
Got it. Okay, switching to residential. Apartments.com.
Apartments.com delivered 11% year-over-year growth in Q3. Consistent performance there. But the real story the CFO highlighted was the investment in the sales team.
Right. They really ramped that up. said the team grew 20% just this year, now over 500 reps.
Yes, surpassed 500 for the first time. That's a significant headcount addition. Obviously, that costs money up front for hiring, training.
Mm-hmm.
But interestingly, despite that cost, their guidance for Apartments.com remains steady. They still expect 11% to 12% growth for Q4 and the full year.
Which implies they expect those new reps to start contributing pretty quickly.
Seems like it. Okay, then there's LoopNet, the big commercial marketplace.
How did that perform?
Q3 revenue growth was 12%. But there's an asterisk there. About 2 percentage points of that growth came from the Domain acquisition, because Domain has some commercial assets too.
Okay, so the purely organic growth for LoopNet was closer to 10%.
Around that, yeah. But the key thing is the acceleration they expect. The CFO projected organic Q4 revenue growth for LoopNet should hit 11%. That'd be its best organic growth rate since 2023. So a sign of life, maybe, in the commercial side.
11% organic Q4. Okay, that's notable.
And it leads to strong total guidance for LoopNet in Q4, expecting 15% to 17% growth overall, including Domain's contribution. The CFO specifically said this sets up the commercial marketplace segment well for 2026.
Right, building momentum. Okay, now we absolutely have to talk about the residential segment overall, because this is where the acquisitions really change the picture.
Hugely. The scale shift here is pretty dramatic when you look at the numbers.
Yeah, Q3 residential revenue was $55 million total. And the breakdown was, what, $23 million from Domain, $32 million organic?
That's right. But look at the full year. The CFO expects total 2025 residential revenue to land somewhere between $210 million and $215 million.
Wow. Compared to what they did last year.
Last year, 2024, was $101 million. So they're expecting to more than double their residential revenue this year.
Driven primarily by the Domain acquisition, obviously.
Absolutely. That deal closed August 27th. Total price tag, roughly USD 1.9 billion. And it started contributing revenue almost instantly.
Yeah, the CFO mentioned that stub period just from August 28th to September 30th added $25 million in revenue.
Just over a month, contributing $25 million. Shows you the scale of Domain right off the bat. And for clarity, the CFO said Domain's revenue is about 90% residential. The other 10% is split between commercial marketplace stuff and information services.
Okay, good context. What about the other revenue category? That's where Matterport lives.
Correct. Q3 other revenue came in at $78 million total. And Matterport's piece of that was $44 million.
But there was a bit of a warning for Q4 in that category.
Yes, a slight dip expected. The CFO guided Q4, other revenue down a bit, to the $70 million to $72 million range. They mentioned a couple of reasons. Some timing things around revenue recognition for their 10X products, and also lower camera sales as they phase out the older Pro 2 camera.
The Pro 2 sunset. Okay, makes sense. Now, something else tucked in there was a mention of future products.
Yeah, specifically for information services. It wasn't a huge part of the financial overview, but significant strategically. They're planning to launch a new rent analytics product in the first half of 2026.
Rent analytics. Interesting.
And then a new integrated lease platform later in 2026 in the fourth quarter. These show they're still investing heavily in evolving that core data and software offering.
So not just integrating acquisitions, but building new value on top of the data they have. Okay. Let's shift to overall financial health, balance sheet, capital returns.
Looking very healthy there.
Yeah.
They ended Q3 with $2 billion in cash sitting on the balance sheet.
It's $2 billion, and it's earning something too.
Yeah, it generated $26 million in net interest income just in Q3. That works out to about a 4% rate of return on their cash pile. Solid. Gives them a ton of flexibility, obviously.
And they're using some of that flexibility for buybacks, right?
They are, actively returning capital.
Yeah.
The CFO detailed $51 million used to repurchase shares in Q3, about 576,000 shares. And the plan is to continue. They expect to buy back roughly another $50 million worth in Q4.
So that would bring the total for 2025 to around $165 million?
Correct, against a larger $500 million authorization they have in place. So, still plenty of room there.
What about customer health? Renewal rates, subscription metrics?
Still looking strong. The overall contract renewal rate in Q3 was 89%, very high. And even better for their most loyal customers, those subscribing for 5 years or more, that renewal rate held steady at 94%. Sticky customer base.
Okay. I did notice one metric change, though, subscription revenue from annual contracts. It dipped slightly.
Yeah, down to 75%. The CFO made a point to explain that. It's not because customers are shifting away from annual deals. It's mainly an artifact of the Matterport and Domain acquisitions, bringing in different types of revenue like transaction fees, hardware sales, things that aren't annual subscriptions. It changes the mix.
Got it. Makes sense. Okay, the grand finale, then. the updated full-year outlook based on this strong Q3.
All right. Full-year revenue guidance is now $3.23 billion to $3.24 billion.
Yeah.
And for Q4 specifically, they're guiding revenue between $885 million and $895 million.
And adjusted EBITDA, given the big Q3 beat.
Also revised upwards significantly. The new full-year adjusted EBITDA range is $415 million to $425 million.
How much of an increase is that from before?
This is the crucial part. The CFO quantified it. It's a $25 million increase to the full-year guidance, excluding the contribution expected from Domain, which is about $15 million itself. So that $25 million organic lift is really the proof point for the strong Q3 execution and that expense discipline paying off.
Right, that's the core operational improvement shining through, and Q4 EBITDA specifically.
Guided between $150 million and $160 million for the fourth quarter.
Okay, so pulling it all together, what's the main takeaway for someone trying to understand the operational health here, based just on the CFO's numbers?
I think the core story is strong operational momentum. You see it in the bookings growth, you see it in the margin improvement, and this is happening even while they're digesting these really large, complex integrations with Domain and Matterport. The balance sheet looks great, costs seem well managed, and the core platforms are showing signs of organic pickup. The numbers paint a picture of pretty solid execution on multiple fronts.
Okay, so here's the final thought, the thing maybe for you, the listener, to really consider as we look towards 2026. The CFO explicitly said the improved guidance, that $25 million organic EBITDA lift, came from both continued expense discipline and better revenue. The really interesting question is, how much of that outperformance is truly down to internal efficiency, tightening the belt and operating smarter?
Yeah.
And how much is maybe just the sheer scale and inherent momentum that comes with integrating massive assets like Domain and Matterport? Getting that balance right, genuine efficiency versus acquired momentum, that feels like the key puzzle piece for figuring out their true financial trajectory going forward.
Yeah, that's exactly the tension to keep an eye on in the quarters ahead.
Definitely. Well, that wraps up our deep dive into the CFO's view of Q3. Thanks for joining us. We'll catch you next time.